Hello, and welcome to the Capital Stewards Podcast. The phrase stock market bubble is in the media a lot, and many of our clients and friends have asked the magic question, are we in a stock market bubble today at the end of August, headed into Labor Day weekend 2025? Is this irrational exuberance or is it rational growth? So on this episode, we'll talk about where things stand relative to past bubbles, and I'll answer the question that no one seems to want to answer on the record, which is, are we in a bubble? So let's dive in. Before we dive into today's history lesson, and we are going to talk about history in a minute, we need to talk for a second about the tools that we use to assess stock market valuation. How much is too much to pay for a stock? When is it overvalued? When is it fairly valued? When's it cheap? The simplest form of valuation, and we're going to talk about this a lot today, is called the market multiple. We look at the price that we pay for a particular share of a company versus that company's earnings or their profits. It's called the PE, or price earnings ratio. If a stock or a stock index has a PE ratio of 10, that means we're paying 10 times the earnings of the company or the companies in the index to own the stock. Another way to think about that is that we would need 10 years of the current earnings to recoup our investment. If all those earnings were just flowing into our piggy bank, it would take us 10 years to pocket those earnings to recoup our investment in the stock. So we'll talk about market ratios as we go through this episode, but just keep in mind when I say PE ratio, that's what I mean. It's the ratio of a stock's price, what we're paying to buy it, to its underlying earnings. In order to know if we're in a bubble now, we need some sort of reference point from prior excesses. There have been two stock market bubbles and subsequent crashes in modern history, and there are more if you go back into the Middle Ages, but we won't do that today. We'll stick with the modern examples. And those two are the 1929 crash. That was one of the factors that led to the Great Depression, and the tech bubble that burst in 2000, more recent memory for most of us, and that led to a recession in the early 2000s. At the beginning of the 1920s, the average stock traded for about 10 times its earnings, so PE ratio of 10. By 1929, stocks were trading at more than 20 times their earnings. So not only had the earnings of the companies grown in the US economy as the economy grew during the roaring 20s, but the price that investors paid for a unit of earnings also doubled over the course of the decade. And then this is where it got really crazy. From the beginning of 1929 to the crash in September, the average valuation moved up another 10 times to almost 32 times earnings before the crash. Part of the speculative excess that ended the party in 1929 was also driven by the invention of margin, which allowed investors to borrow money to buy stocks for the first time. That magnifies returns on the way up and also on the way down, and that partially contributed to the bust that sparked the Great Depression. Notably, in 1929, there wasn't one specific event like a company earnings miss or a bad set of economic data that came out that triggered the crash that we call Black Thursday in 1929. Sentiment among some prominent investors just shifted, and investors began to sell. And since the market was built up on so much leverage, the whole market collapsed as investors that had invested borrow money were forced to sell to repay the debt. When you borrow on margin, what happens is the brokerage firm that you're borrowing from will allow you to lose money over time, but they won't let you lose more generally than you borrowed. And they don't want to be upside down on your loan. And so what happens is they call your loan. And so they take all the rest of the stock that's in your account and force you to sell out before you can lose more money than you had to start with. So it can create this, this acceleration that happens on the way down when investors are forced to sell. So let's turn now to the 1990s. In the 90s, a new wave of technology raised optimism that personal computers and the internet, hello, Bill Gates, were going to revolutionize the economy. And the companies that were behind that revolution stood obviously to benefit financially, and folks wanted to invest. By the mid-1990s, investors began buying up internet and tech stocks at a frenzied pace. A great example of this, maybe my favorite example, was Webvan, which promised Amazon-like home delivery services for a myriad of products. They were actually right. Lots of people would use the internet to buy stuff. They were just 20 years too early. The problem was that Webvan, like I said, was ahead of its time. It never actually turned a profit. Not 100 million, not 1 million. Webvan lost money every single year that it existed. We talked about PE ratios earlier. It never had a PE ratio because when the earnings are zero, you can't calculate the PE ratio. But that didn't stop investors from piling into its IPO, which valued the company, again, that was loss-making with zero profits in its history. The company was valued at $4.8 billion. Investors didn't stop there. The stock rose to a total market capitalization of $8.8 billion before it eventually went bankrupt because it never actually made any money. There are lots of examples of companies from the late 1990s where investors simply didn't do diligence on the business prior to investing. And the companies just never had the economic prospects that were touted in the press or that investors thought they had when they bought shares in an IPO. The broad market S&P 500 started off the 1990s at around 15 times earnings, and then that rose to 25 times earnings, so similar to what we saw in 1929 before the bubble burst in 1999. Like the 29 crash, there was no one event that caused investors to sell. The Fed raised rates starting in 1999 to combat inflation that was picking up as a result of the asset bubble. As people made money in the stock market, they started to buy up other assets that caused asset prices to rise, like houses, and the Fed wanted to make sure inflation didn't get out of control, which is the right thing for them to do. Investors began to look more closely as the Fed was raising rates at some of these dot-com companies, and those companies also failed to have any profits, right? Everybody expected they would start generating profits, and they just never actually got there. Another component that was similar to 29 is that investors also used margin loans to buy stocks on the way up, and that debt made the crash worse as investors were forced to sell out again to repay their debt on the way down. So what does history tell us about bubbles? First, in both instances, you saw a significant valuation increase, 1/3 of the market or more, in a short period of time, indicative of kind of speculative excess because company performance didn't generally improve that much that quickly. Second, you saw sort of a loss of rationality. Investors were piling in blindly instead of doing their homework in the value of the underlying companies. And then third, it's really difficult to know when sort of this irrational exuberance will stop. Neither of those modern bubble events had some major event, an economic release, something that happened that caused sentiment to change. It just changed, and when it did, it changed it very quickly. So let's look at where we stand today, compare our current situation to history. History doesn't repeat itself, right? But it usually does rhyme. And so I think it's instructive to learn what we can from the past and then also think critically about the current situation that we're in today. So let's start with the valuation of the stock market. Is it expensive or fairly valued? One good way to measure long-term valuation is called the CAPE ratio. Remember the PE ratio that we've been talking about, the Shiller CAPE ratio is based on price earnings ratios or PE ratios, but it smooths out normal sort of business cycle variability that we see over time. So you can use it to value the market over longer term periods of time. You can see in the chart, the CAPE ratio is now about 37, so it's currently high. It's moved up a lot over the last couple of years. It's just now in line with the ratio that we saw in 2021 before the Fed started raising rates around 37. During the tech bubble, the CAPE ratio peaked about 44. So today, certainly elevated, maybe a yellow light, but we do have some room to run based on prior market bubbles. We talked again about PE ratios earlier. Currently, the S&P 500 trades at 22 times next year's earnings. The 10-year average is closer to 18 times, so a little bit above that. The peak in the tech bubble was around 25 times forward earnings. So 22 may sound close to 25, but remember, we're talking about multiples of earnings. So to get the multiple of 25 times next year's earnings, the market would need to rise to about 7,500 from 6,800 today. That's another 17% increase. And of course, the earnings would need to basically be just in line with consensus, which is currently around $303 a share for the S&P 500 over the next year. If the earnings outperform that, if we do better than folks expect, then the market would need to go up even more to get to that 25 times earnings level that would be sort of representative of the tech bubble. So on a PE basis, the market's certainly not cheap. That would be below 18 times earnings, but it's also not as expensive as it was in 2000. So again, I think sort of a yellow light type scenario, and you're going to see that more as we talk through where we are today. When we compare it to history, I think it's also worth looking at the pace of the increase in market multiples. Both of our recent historical examples, we saw really significant run-ups in valuation over a year or less as sort of that speculative frenzy moved into its sort of peak. And the market moved a lot faster than companies could actually develop their businesses and drive future earnings growth. We haven't really seen that in this market yet. The market last bottomed at 18 times earnings at the end of 2022. If you remember, the market sold off as the Fed started to raise interest rates. But since then, over the last 2 years, the market multiples only expanded by 4 times from 18 to 22, which is where we're at today. If we were tracking something like the 1929 crash or the 2000s tech bubble, we would expect the market to move up by more like a third over that period of time. So we would need to see where 24 times, 25 times and maybe headed higher. So while the pace over the last couple of years has felt fast, it's been more orderly than some of the historic run-ups that we have seen. That slower pace allows companies to improve their underlying business performance to sort of keep up with the market. And the same thing, by the way, is true when we look at metrics outside of PE, price book, price to cash flow ratios. When we value the market really in a professional context, we don't just look at one thing. We look across the board, lots of different metrics. Most of what you see there is that the market is not cheap. It's probably overvalued. It's in sort of like the high valuation area, but it's not extreme. So let's talk a little bit about the underlying companies. I mentioned a second ago that the underlying business performance of companies has in some ways allowed, the market to move higher because the companies are actually performing, right? Let's look at NVIDIA, which has been the poster child of a run-up in valuations this cycle. Yes, NVIDIA's price is up a lot. The stock price is up a lot, but its multiple has increased as well. But that's not without sort of real underlying company performance. NVIDIA's net income has moved up from around $4 billion at the end of 2022. So calendar year 2022, their profits take-home cash flow was $4 billion, we'll call it that. It's now tracking over $70 billion a year. That's a massive increase in real profits generated by the company. Alphabet, better known to many as Google, has seen net income move up from $75 billion annually to north of $115 billion. Meta or Facebook, even better, Instagram, their net income has gone from $40 billion to $70 billion annually. So there has been real growth associated with the increase in valuation, many of the tech companies driving this rally. So that's different than what we saw in the 2000s, where maybe the underlying company performance didn't support the increase in cash flow. These companies today are generating sort of tens of billions of dollars in profit each quarter. So we're not looking at sort of a web band kind of situation, I think, today. One of the other things we saw in historical bubbles that we talked about was the excessive use of margin to help investors buy more stock than they could otherwise afford. Margin usage, there you go, say that 5 times fast, has been in the news lately a lot. FINRA, which is one of the regulatory bodies responsible for the investing industry, announced that outstanding margin debt had reached all-time highs in July of this year. I think it's important, though, that we evaluate aggregate debt balances in line with the size of the economy. So let's just step out of the investing world for a second and think about consumer debt. Consumer debt hits a new high almost every single year. Does that mean that consumers are over leveraged? Not necessarily. The economy is growing. There are more consumers making more money, and so there is more debt. What really matters is the size of consumer debt relative to consumer income. That's a much better indicator of how well consumers are doing than just sort of the overall aggregate debt level, which does grow every single year because the economy is growing. There's more people. So margin debt now is just over $1 trillion. However, it's only just over 3% of GDP. We saw margin debt above 3% of GDP in 2017. There was obviously no crash in 2017. You haven't heard about the crash in 2017 because it didn't happen. We also saw margin debt touch 3% of GDP in the late 90s before the tech bubble. So while the level of margin debt is concerning, I don't think it alone is an indicator that the market is overextended. However, I think margin debt as a percentage of GDP is up. You can see on the chart, up almost a full percentage point over the last 2 years. So given the rapid rise in the level, I do think, again, it's another yellow light, sort of worth watching, because if we do get a market drawdown, I think there's enough margin debt now that it will accelerate the downward move in stocks if investors are forced to sell. Alongside margin debt, I think there's 2 other issues that don't get as much press related to market structure that are worth watching for investors. The first is the use of options by retail investors. That's expanded a lot over the past decade. Options have inherent leverage within them. You can buy an option to buy 100 shares of stock for a lot less money than you can buy 100 shares of stock. So when the market turns and the options activity dries up, that may exaggerate the move on the downside. The same is true with leveraged ETFs. Many investors are effectively using leverage by owning ETFs, like say the triple leveraged NASDAQ. That employs leverage, but they're not actually borrowing directly in their margin account that gets tracked by FINRA. So I think there's a lot more leverage in the market than we actually really even understand. And all of that, I think, is a big flashing yellow light for a potential downward correction. So if we do get a drawdown, it's probably going to be worse than it otherwise would be, because I do think there's a pretty healthy amount of leverage that's been built up. All right, so last factor here, in all of our historical examples, attempting to predict whether we were in a bubble was difficult to do because investor sentiment had shifted, really suddenly, almost inexplicably. That means that investors need to be disciplined and not chase the market on the upside. Your portfolio should include some of the high growth stocks that have done so well, but you should also own other slower growing assets like bonds and gold, things that will do okay most years, but they'll do really well if the stock market does move down significantly. Staying disciplined and sticking with your asset allocation, your investment program over time has a much higher likelihood of success than you trying to be the one person that successfully calls whether we're at the top of the bubble or at the bottom of the bubble. And remember, you've got to be right twice. You've got to call it both on the top, and then you've got to get out. Then you got to get back in at the market bottom. It's really difficult to do that correctly, especially when we look back at history and we see that there wasn't one event that led investor sentiment to shift. It just shifted, and it just shifted quickly. So it's important that you're well positioned before that happens. So if we sum it all up, I think the market is expensive on a valuation basis. Anyone that isn't actively thinking about the market's high valuation probably needs to come out from under the rock that they're living in, put their glasses on. But I think we're in more of a yellow light kind of moment than an imminent bubble. There's a real underlying business momentum from companies whose stock prices have increased the most. And that means that those upward movements, even if they are exaggerated, right? Even if the upward movement in NVIDIA stock is probably more than it should be, most of that move is deserved based on the underlying fundamentals of the company. It's not a 2000s kind of scenario. The margin debt, options, leverage ETFs, we talked about all of that. That's a yellow light. It's not concerning in and of itself, but it could become a problem if the economy turns and causes the market to go down. So in short, I don't think that valuation or sort of the structure of the market is going to cause a drawdown in and of itself really quickly. I think if we have a recession, then conditions are ripe for a really significant market correction. And sort of despite the bad labor market data that we saw from the summer, the early indications on the economy from August is that activity's picking up a little bit after kind of slowing down in June and July. So I think the key watch item is really the consumer and the labor market. That's going to tell the story of the economy. If we can manage to avoid a recession, if we don't fall into a recession, and that's currently our expectation, if you watched the Q3 outlook, then you'll understand that. Then I think the market can continue to grind higher, right? So regardless of the market outcome, again, trying to time the market is very difficult to do, not something that I recommend doing. You should be investing in a disciplined and diversified way, and you should be comfortable, right? This is really important. If where the market is right now and where your portfolio is makes you uncomfortable, then that probably means you're not diversified enough, right? So you should be investing in a disciplined, diversified way so that you're going to have a good outcome for your investment goals. You're going to still be able to achieve your investment goals, regardless of whether we get a correction in tech stocks or the rest of the market or not over the next couple of years. So just some thoughts on market bubbles. I hope you find that helpful. Thanks for tuning in to this episode of the Capital Stewards podcast, and we will see you next time.